Dealership lots across America are becoming graveyards for certain vehicles that simply won't sell. The latest August 2025 inventory data reveals a shocking reality that manufacturers are desperately trying to hide. Some models are sitting unsold for over 400 days while dealerships slash prices to no avail. This isn't just a temporary market adjustment, it's becoming a full-blown crisis as interest rates remain elevated and consumer preferences continue shifting faster than manufacturers can adapt. What's particularly alarming is how quickly this inventory disaster is accelerating. Models that took 150 days to sell just 6 months ago are now approaching a full year on dealer lots. The financial implications are staggering. With floor plan financing costs skyrocketing, dealers are losing thousands on each of these vehicles even before considering the massive discounts required to eventually move them. Most concerning of all, several major manufacturers appear to be in complete denial, continuing to ship these unwanted vehicles to dealers despite overwhelming evidence of market rejection. The result? A building inventory bubble that threatens the financial stability of dealerships nationwide and points to deeper problems within the automotive industry that could trigger a wave of bankruptcies if current trends continue. What most automotive journalists won't tell you is that this sales collapse isn't limited to budget brands or gas-guzzling dinosaurs. It's affecting luxury manufacturers, electric vehicles, and even supposedly hot segments like crossovers. The data reveals premium European brands with established reputations experiencing inventory backups that would have been unthinkable just 2 years ago. Even more surprising, electric vehicles, long touted as the industry's unstoppable future, are among the hardest-hit segments. Several EVs now rank among the absolute worst-selling vehicles nationwide, sitting on lots for 8 to 10 months, despite manufacturer claims of strong demand and supply constraints. The factors driving this rejection go far beyond simple range anxiety or charging infrastructure. But perhaps most shocking is how specific brands dominate this list of automotive failures. Stellantis, parent company of Dodge, Jeep, Chrysler, Fiat, Maserati, and Alfa Romeo, appears repeatedly among the worst offenders, pointing to a potential existential crisis for the troubled conglomerate that insiders suggest could lead to dramatic restructuring announcements before year-end. Which specific models are collecting dust on dealer lots, and what factors are driving their catastrophic market rejection? To answer this question definitively, we've analyzed comprehensive inventory data spanning thousands of dealerships nationwide, providing a clear picture of exactly which vehicles buyers are actively avoiding and why. This isn't subjective opinion, it's based on market day supply, the most accurate measure of how quickly vehicles are actually selling. When a model has a 200-plus day supply, it means dealerships have enough inventory to last 200-plus days at current sales rates, a clear indicator of severe market rejection that no amount of manufacturer spin can disguise. Let's count down the 10 vehicles that dealers simply cannot sell as of August 2025, starting with concerning cases and working our way to the absolute worst inventory disasters currently plaguing showrooms nationwide. Number 10. Alfa Romeo Giulia, 221 days supply. The Alfa Romeo Giulia attempts to deliver Italian passion in a luxury sedan package, but American consumers have delivered a clear verdict on this Stellantis product. Why it's not selling. Despite its striking design and engaging driving dynamics, the Giulia has become a showroom fixture that dealers simply cannot move. With just 122 units sold nationwide in the past 45 days against an inventory of 600 vehicles, the model has reached a critical 221-day supply, meaning it would take over 7 months to clear existing inventory even if production stopped entirely. At an average selling price north of $55,000, the Giulia faces an uphill battle against established German competitors with stronger reliability reputations and more comprehensive dealer networks. Stellantis' struggles across multiple brands have further undermined consumer confidence in the company's long-term commitment to the American market. What makes the Giulia's situation particularly concerning is that Alfa Romeo has already announced the end of production for the current generation, creating a depreciation death spiral as remaining inventory becomes increasingly difficult to sell. For potential buyers, this creates both opportunity and risk. Substantial discounts are available, but future parts availability and service support remain legitimate concerns. The Giulia's struggles highlight broader challenges for Stellantis in the luxury segment, where brand equity and perceived quality play outsized roles in purchase decisions. Despite positive critical reviews, the Giulia has failed to overcome consumer skepticism about Italian reliability and dealer support. Number 9. Mini Convertible. 232 days supply. The Mini Convertible offers open-air fun in a distinctive package, but its sales have hit a surprising summer slump that has dealers concerned. Why it's not selling. In what should be peak convertible selling season, the Mini Convertible has accumulated a troubling 232-day supply, with 1,585 units sitting on dealer lots nationwide. Despite selling 307 units in the past 45 days, inventory levels remain critically high, creating pressure for dealers to offer increasingly aggressive discounts to move product. What makes this situation particularly puzzling is the Mini Convertible's unique position in the market, offering distinctive styling and engaging handling in a segment with limited competition. However, the model's premium pricing relative to its size and practicality has created resistance in a market where consumers increasingly prioritize utility and value. The convertible's struggles may also reflect broader challenges for the Mini brand, which has seen its distinctive appeal diluted by expanding into larger vehicles while failing to keep pace with competitors in technology and interior quality. This identity crisis has left potential buyers uncertain about what the brand represents beyond retro styling cues. For potential buyers, the Mini Convertible's inventory glut creates significant negotiation leverage, with dealers increasingly motivated to move these vehicles before the summer selling season ends completely. Reports indicate discounts of $4,000 to $6,000 below MSRP are becoming common as desperation grows. Number 8. Porsche Taycan. 234 days supply. Porsche's flagship electric vehicle was supposed to demonstrate that performance and electrification could coexist seamlessly. Instead, it's become one of the slowest-selling vehicles in America. Why it's not selling? The Taycan faces a perfect storm of challenges that have resulted in a concerning 234-day supply, with 1,837 units sitting on dealer lots nationwide against just 372 sold in the past 45 days. At an average selling price of $143,850, the Taycan asks buyers to make a significant financial commitment to electric technology that many luxury performance buyers remain hesitant to embrace. What makes the Taycan's struggles particularly notable is Porsche's otherwise strong market position. The brand's conventional models continue selling well, suggesting the issue isn't with the brand itself, but specifically with the Taycan's value proposition. The model's limited range compared to Tesla alternatives has proven a significant hurdle for potential buyers, despite the Taycan's superior driving dynamics. The luxury EV segment has also become increasingly competitive, with new entrants from Mercedes, BMW, and Lucid offering compelling alternatives that challenge the Taycan's early mover advantage. This competition has eroded the model's exclusivity while highlighting its compromises in range and charging infrastructure. For potential buyers, the Taycan's inventory challenges create unprecedented opportunities to acquire Porsche's electric flagship at significant discounts. Dealers report increasing willingness to negotiate on these vehicles, with the discounts of $15,000 to $20,000 below MSRP becoming increasingly common as inventory ages. Number 7. Ford Mustang Mach-E. 243 days supply. Ford's electric crossover was supposed to bring EVs to the mainstream. Instead, it's become a cautionary tale in misreading the market. Why it's not selling. The Mustang Mach-E's market position has deteriorated dramatically, reaching a troubling 243-day supply with 23,363 units sitting on dealer lots nationwide against just 4,324 sold in the past 45 days. This massive inventory buildup represents one of the most significant EV market failures to date, particularly concerning given Ford's substantial investment in the model. What makes the Mach-E situation particularly alarming is the scale of the inventory problem. The raw number of unsold units dwarfs most other vehicles on this list, creating a financial burden for both Ford and its dealer network. The model's controversial use of the Mustang name appears to have alienated traditional buyers without sufficiently attracting new EV customers. The Mach-E also suffers from positioning challenges, priced significantly higher than conventional crossovers while failing to deliver the premium experience of luxury competitors. This middle ground approach has left the model without a clear value proposition as EV tax credits have phased out and competitor offerings have expanded. For Ford, the Mach-E's struggles represent a significant setback in their electrification strategy, with billions invested in a product that consumers have clearly rejected despite extensive marketing and incentives. Dealers report increasing pressure to accept Mach-E allocations they don't want, creating tension within the Ford retail network. Number 6. Volvo V60 Cross Country, 259 days supply. The Volvo V60 Cross Country attempts to keep the wagon segment alive with Scandinavian design and mild off-road capability, but American consumers remain overwhelmingly uninterested. Why it's not selling? The V60 Cross Country has accumulated a concerning 259-day supply, with 715 units sitting on dealer lots nationwide against just 124 sold in the past 45 days. Despite positive critical reception and a loyal niche following, the model has failed to generate meaningful sales volume in a market dominated by conventional SUVs and crossovers. What makes the V60 situation particularly challenging is Volvo's broader struggle to maintain market share in an increasingly competitive luxury segment. The brand's transition toward electrification has created confusion in its product lineup, with the V60 Cross Country lacking a clear position as neither fully electric nor particularly fuel efficient. The wagon body style continues to face significant resistance from American consumers despite automotive journalists' persistent praise for the format's practical advantages. This fundamental disconnect between critical acclaim and actual consumer preference has trapped the V60 Cross Country in a perpetual niche status with insufficient volume to justify its continued existence. For the handful of wagon enthusiasts, the V60 Cross Country's inventory challenges create significant negotiation leverage, with dealers increasingly motivated to move these slow-selling vehicles through substantial discounts that would have been unthinkable for Volvo just a few years ago. Number 5. Dodge Hornet, 266 days supply. The Dodge Hornet attempts to inject some American muscle attitude into the compact crossover segment, but consumers have delivered a clear rejection of this Stellantis offering. Why it's not selling? The Hornet has returned to the slowest selling list with a troubling 266-day supply, with 2,868 units sitting on dealer lots nationwide against just 485 sold in the past 45 days. Despite a relatively accessible average selling price of $36,536, the model has failed to generate meaningful consumer interest since its introduction. What makes the Hornet situation particularly concerning is its position as one of Dodge's few remaining volume models following the discontinuation of several long-standing nameplates. As Stellantis attempts to reinvent the Dodge brand, the Hornet's market rejection represents a significant setback in establishing a sustainable product lineup. The Hornet's fundamental challenge lies in its derivative nature, essentially a rebadged Alfa Romeo Tonale with minimal differentiation beyond cosmetic changes. This transparent platform sharing has undermined the model's value proposition, with consumers questioning why they should choose the Dodge version over competing products with stronger brand identities. For Stellantis, the Hornet's struggles reflect broader challenges across multiple brands, with product planning decisions increasingly driven by cost-saving measures rather than coherent brand strategies. This approach has created a portfolio of vehicles that fail to resonate with their intended audiences despite competitive specifications on paper. Number 4. Maserati Grecale, 302 days supply. The Maserati Grecale attempts to bring Italian luxury to the midsize crossover segment, but its sales performance has been anything but luxurious. Why it's not selling? The Grecale has reached a critical 302-day supply, nearly a full year's worth of inventory, with 644 units sitting on dealer lots nationwide against just 96 sold in the past 45 days. At an average selling price approaching $80,000, the model has failed to convince luxury buyers that it deserves consideration against established German and Japanese competitors. What makes the Grecale situation particularly alarming is that it represents another Stellantis luxury offering struggling to find market acceptance. This pattern across multiple premium brands suggests fundamental issues with how the conglomerate approaches the luxury market, consistently failing to deliver products that resonate with target customers. The Grecale suffers from Maserati's uneven reputation for reliability and quality, concerns that become particularly significant at its premium price point. Despite attractive styling and genuine performance credentials, the model has failed to overcome the brand's historical baggage and establish itself as a credible alternative to more established luxury crossovers. For potential buyers, the Grecale's inventory glut creates unprecedented opportunities to acquire Italian luxury at significant discounts. Dealers report increasing willingness to negotiate on these vehicles, with discounts of $10,000 to $15,000 below MSRP becoming increasingly common as inventory ages and carrying costs mount. Number 3. Audi A4. 312 days supply. The Audi A4 has long been a cornerstone of the German luxury brand's lineup, but its current generation has overstayed its welcome in a rapidly evolving market. Why it's not selling? The A4 has reached a critical 312-day supply, over 10 months of inventory, with 5,422 units sitting on dealer lots nationwide against just 778 sold in the past 45 days. This massive inventory buildup represents one of the most significant luxury sedan market failures in recent years, particularly concerning given Audi's otherwise strong brand position. What makes the A4's situation particularly challenging is that it stems primarily from product lifecycle issues rather than fundamental concept problems. The current generation has been on the market since 2016 with only minor updates, leaving it outdated in technology, design, and efficiency compared to newer competitors and even other Audi models. The A4's struggles also reflect broader challenges in the luxury sedan segment, which continues losing ground to crossovers and SUVs across all price points. However, the severity of the A4's inventory backup far exceeds segment trends, pointing to model-specific issues beyond categorical decline. For Audi, the A4's market rejection represents a concerning vulnerability in what was historically one of its core volume models. With an all-new generation reportedly delayed multiple times, the brand faces increasing pressure to either significantly discount current inventory or accelerate the replacement model's introduction. Number 2. Jaguar F-Pace. 336 days supply. The Jaguar F-Pace attempts to blend British luxury with crossover utility, but consumers have delivered a brutal verdict on its value proposition. Why it's not selling? The F-Pace has reached a critical 336-day supply, nearly a full year of inventory, with 2,841 units sitting on dealer lots nationwide against just 380 sold in the past 45 days. This inventory crisis comes amid broader uncertainty about Jaguar's future direction, creating a perfect storm of consumer hesitation. What makes the F-Pace's situation particularly concerning is Jaguar's announced plans to completely reinvent itself as an ultra-luxury electric brand, effectively orphaning current models with unclear long-term support prospects. This strategic shift has created legitimate concerns among potential buyers about future parts availability, service support, and resale value. The F-Pace also suffers from Jaguar's historical reliability concerns and a dealer network significantly smaller than competing luxury brands. These structural disadvantages create additional hurdles for a product already struggling to differentiate itself in the crowded luxury crossover segment. For Jaguar dealers, the F-Pace inventory crisis represents an existential challenge, with floor plan financing costs mounting daily on vehicles that show little sign of movement despite increasingly desperate discounting. Reports indicate discounts of $15,000 to $20,000 below MSRP are becoming common as dealers attempt to convert these assets to cash before the brand's planned transformation. Number 1. Nissan Versa. 472 days supply. The Nissan Versa attempts to deliver affordable transportation in a market increasingly abandoning entry-level sedans, resulting in the single worst inventory crisis in the industry. Why it's not selling. The Versa has reached a staggering 472-day supply, over 15 months of inventory, with 2,369 units sitting on dealer lots nationwide against just 226 sold in the past 45 days. Despite an accessible average transaction price under $16,000, the model has failed to generate consumer interest even as affordable transportation options continue disappearing from the market. What makes the Versa's situation particularly perplexing is that it exists in a segment with minimal competition following the discontinuation of many competitor offerings. As one of the few remaining truly affordable new cars, its market rejection suggests fundamental issues with how consumers view entry-level sedans regardless of price. The Versa's struggles reflect shifting consumer preferences toward used vehicles when budgets are constrained, with many buyers preferring a 3 to 4-year-old compact crossover over a new subcompact sedan at similar price points. This value perception challenge has proven insurmountable despite the Versa's improved design and feature content compared to previous generations. For Nissan, the Versa's inventory crisis represents a significant strategic challenge, raising questions about the viability of the entry-level sedan segment entirely. With carrying costs mounting daily on vehicles that show little sign of movement, the financial pressure to resolve this inventory situation grows increasingly urgent. The implications of this inventory crisis extend far beyond these specific models to threaten the entire automotive ecosystem. For dealers, floor plan financing, the loans used to purchase inventory from manufacturers, typically charges interest based on how long vehicles remain unsold. Models sitting for 250-plus days generate catastrophic carrying costs that can eliminate profit margins entirely, even with substantial manufacturer incentive support. This financial pressure is creating unprecedented tension between dealers and manufacturers, with many retailers actively refusing allocations of slow-selling models despite contractual obligations and manufacturer pressure. Industry sources report dealers increasingly willing to risk franchise agreements rather than accept additional inventory they know will sit unsold for months. What makes this situation particularly alarming is how the inventory crisis disproportionately affects certain manufacturers. Stellantis appears 5 times across various brands in extended day supply situations, suggesting systemic problems that threaten the conglomerate's North American operations. Industry analysts have begun questioning whether all current Stellantis brands can survive if these inventory trends continue. The electric vehicle segment's prominent appearance among the slowest-selling models raises serious questions about the pace and scale of the industry's electrification strategy. With billions already invested in EV development and production capacity, the market rejection of current offerings creates existential questions about the financial viability of manufacturer transition plans. What makes these inventory failures particularly revealing is how they contradict carefully crafted narratives from automotive executives and marketing departments. While earnings calls highlight strong demand and pricing power, the reality on dealer lots tells a completely different story of desperation and market rejection. Even more striking is how the inventory crisis cuts across traditional market segments and price points. From $16,000 economy sedans to $140,000 electric sports cars, the common thread isn't price or category but fundamental disconnects between what manufacturers are building and what consumers actually want to buy. The data reveals a particularly alarming trend for electric vehicles, with several models appearing among the slowest-selling vehicles nationwide, despite massive manufacturer investment and marketing. This suggests the EV transition is facing more significant consumer resistance than publicly acknowledged, with many buyers unwilling to accept the compromises and uncertainties of current electric offerings. Perhaps most revealing is how manufacturer responses to these inventory problems follow predictable patterns regardless of effectiveness. Initial reactions typically involve increasing incentives while maintaining production, followed by desperate fleet sales to rental companies, and finally production cuts only after inventory reaches crisis levels, a playbook that repeats despite consistently poor outcomes. For consumers, this inventory crisis creates both opportunities and risks. Models with severe inventory backups offer unprecedented discounting and negotiation leverage, potentially creating value for informed buyers willing to accept these vehicles' market-rejected characteristics. However, these same factors likely mean accelerated depreciation and potential service challenges if manufacturers ultimately abandon models that fail in the marketplace. Dealership lots across America have become automotive graveyards for certain models that consumers have clearly rejected. Our analysis of August 2025 inventory data reveals 10 vehicles that represent the worst of this crisis. Models sitting unsold for 221 to 472 days, while desperate price cuts fail to generate buyer interest. The Nissan Versa tops our list with a staggering 472-day supply, meaning it would take nearly 16 months to sell existing inventory even if production stopped entirely. The Jaguar F-Pace follows at 336 days, representing a concerning market rejection for a brand already facing existential questions about its future. The Audi A4, 312 days, Maserati Grecale, 302 days, and Dodge Hornet, 266 days, round out the top 5, each representing significant financial burdens for their manufacturers and dealers. The Volvo Phi 60 Cross Country, 259 days, Ford Mustang Mach-E, 243 days, Porsche Taycan, 234 days, Mini Convertible, 232 days, and Alfa Romeo Giulia, 221 days, complete our list, each sitting unsold for more than 7 months on average as consumer preferences and market conditions continue shifting faster than manufacturers can adapt. For shoppers, these inventory disasters create unprecedented buying opportunities with discounts of $10,000 to $20,000 below MSRP, becoming increasingly common as dealers grow desperate to convert aging inventory into cash. However, buyers should consider the factors driving these vehicles' market rejection, as the same issues will likely impact long-term ownership satisfaction and eventual resale value. The message for manufacturers is clear but painful. Production volumes must align with actual demand rather than optimistic projections, and product planning must prioritize genuine consumer needs over design trends or internal corporate goals. For dealers, these inventory challenges necessitate careful model mix management and potentially difficult conversations with manufacturer partners about allocation preferences. As we move deeper into 2025, watching how manufacturers respond to these inventory challenges